Dear all, good morning, very good morning. Now we are going to start the third class of this capital structure under the management accounting. As you know, there are different methods of approach to the capital structure, and net income approach, or it is called NI approach. Net operating income approach is called NOI approach. Modigliani-Miller approach, traditional approach. There are four approaches generally in your syllabus. The first one is your net income approach. The second one is your net operating income approach or NOI approach. The third one, Modigliani-Miller's approach, MI approach. The fourth one is your traditional approach. So out of these four approaches, the first one we are going to discuss is your net income approach. This particular method is suggested by David Durant in 1959. It is the net income means net operating income minus interest on debt. That is your net income. So in this case, we have to find out the net income, that is your EBIT, earnings before interest and tax, minus interest, that is your net operating income is called EBIT minus I is equal to your EBT, and this EBT is called net income, and this income is available for equity shareholder. So the next point is capital structure is relevant for the value of the firm. The value of firm depends on the capital structure. The overall cost of capital changes with capital structure. This is true. Suppose a company with 100 crore, they have got 60 crore as equity and 40 crore as debt. So what the company did, from 60 crore, 40 crore debt, they make it 100 crore debt and 60 crore equity. So the capital structure changes, the ratio of capital changes, the ratio of debt and equity changes, and definitely the cost of capital will change. A high debt equity ratio in the capital structure will result in the decline of weighted average cost of capital, WACC, that means weighted average cost of capital. But how it happens? A high debt ratio, that means debt is more and equity is less. Cost of debt is less than cost of equity, or cost of equity is higher, cost of debt is less. So if you take 100 crore total capital, 60 crore is the debt and 40 crore is the equity, the overall cost will be less because the cost of debt is less and cost of equity is higher. If we change the ratio, equity is 60 crore and debt is 40 crore, definitely the overall cost of capital will increase because the cost of equity is higher than the cost of debt. So a high debt equity ratio will decrease the overall cost. As a result, the value of the firm will increase. As the cost decrease, as the overall cost decrease, weighted average cost of capital decrease, the value of the firm increase. Let us come to according to this particular approach, change in financial leverage. Financial leverage means debt equity ratio. So when the debt equity ratio changes, weighted average cost of capital or overall cost of capital changes, and debt is favorable than the equity. This is the basic assumption of net income approach. The cost of debt here, the cost of debt is less than cost of equity. So if debt become more, equity become less, the total cost become less. As a result, the value increases. So as per NI approach, when weighted average cost or overall cost of capital decrease, the firm value increase and vice versa. The rate of return on investment, that means whatever the company has a capital, if it is investing on the project, the return from the project is called the rate of return on investment. And this rate of return on investment is greater than weighted average cost or overall cost of capital. Therefore, the value of the firm increase. Let us consider an example. If 100 crore is the total capital and weighted average cost of capital WACC is 10% and return on investment is say 15%. So return on capital is 15% and cost of capital is 10%. So return is 15 crore and cost is 10 crore. That means this 5 crore will be added to the benefit of the shareholder. As a result, the value of the share increase. The EPS will increase. When EPS increase, the value of the firm increases. So value of the firm is equal to earnings divided by weighted average cost of capital. The earnings is a constant one. Here you see the earnings is constant. As per our assumption also the earnings is constant, and weighted average cost changes with change in capital structure. When weighted average cost decrease, the value of firm increase. When weighted average cost increase, the value of firm decrease. The earnings show WACC is inversely proportional to the value of the firm. As per this approach, the cost of capital is minimum. When there is a 100% debt, that means there is no equity. The company is operating on debt. Therefore, capital structure is optimized under this approach when the debt is 100%, because the cost of debt is less, cost of equity is higher. So let us come to, under this approach, what are the assumptions? The first assumption is there is no corporate tax. So the net income is available for equity shareholder. The cost of debt is less than cost of equity. As the cost of debt is less, therefore debt is favorable to the business. Capitalization rate remain constant over time. That means cost of equity. Investors are only concerned with their desired return. Investors are only thinking that how much they will get the return. The investors' return can be divided into two parts. One is their dividend, another one is their appreciation in the value of share. And they are concerned with these two factors. One is your dividend, another one is your capital appreciation in the value of share. Cost of debt remain constant and irrespective of the level of debt. If the debt is too high, cost remains same. If the debt is too low, the cost remains same. And the dividend payout ratio under this approach remain 100%. These are the assumptions of this particular NIE approach. Now we will go for the structure, that is your the graph, how the NIE, how the value of the firm behaves with the change in overall cost of capital. So you just see the graphical representation of NI. This is the cost of equity. Cost of equity is higher, cost of debt is lower. This is the assumption. KD, cost of debt, that is 10%, cost of equity, it has been taken as 15%. So as the debt become more, the firm become more leverage. As the debt increases, this is your x-axis. X-axis is your financial leverage or debt in the capital. If the debt and y-axis, this is the cost of capital. So in the x-axis we have taken this one. This is debt in capital. As the debt increases, as you are going out from the origin, the debt increases. As the debt increases, the overall cost of capital, WACC, the overall cost decreases. This is the red line, how the overall cost decreases. And as the overall cost decreases, the EPS will increase, the value of firm will increase, and the wealth of the shareholders, wealth of the investors will also increase. This is the graphical representation of NI. Now we are coming to the formula for NI approach. The value of the firm is called V. V is equal to S plus B. S is equal to value of share. B equal to value of debt. The market value of equity is NI, that is your EBT. NI by KE into 100. KE is your equity capitalization or cost of equity. In this way, we can find out the cost of equity. Book value of debt we can find out from the interest, or it is given in the problem. So the total value of the firm will be V equal to S plus B. Now you can understand more by going through a problem on NI approach, right? This is a problem on NI approach. Alpha Limited has earned a profit of 40 lakhs before providing interest and tax. That means 40 lakhs is your earnings or EBIT. The company's capital structure is like this: 8 lakh equity share of 10 each, 80 lakhs. Market capitalization rate, that is 15.5%. 50,000, 12% redeemable debenture of 150 each. So 50,000 into 150, 75 lakh is your debenture and 80 lakh is your equity. You are required to calculate the value of the firm under NI approach. Assuming there is no tax, calculate the overall cost of capital. So friends, let us come to this one. This is the solution. Earnings before interest and tax, that is your 40 lakhs. Interest is 50,000 into 150. So the total debenture is 75 lakh. If we take 75 lakh into 12%, it will come to 9 lakh. So earnings available to equity shareholder is 40 minus 9, that is equal to 31 lakh. So equity, if this is the earnings available to equity shareholder, equity capitalization rate is 15.5. So if you divide 31 lakh divided by 15.5, if you invest 100 rupees, then 100 rupees of equity, then the rate of return is 15.5. So if you get the rate return as 31 lakh, how much is the investment in equity? That is your market value of equity. So the market value of equity is your earnings or NI divided by KE into 100. So 31 lakh divided by 15.5%, or you can take 31 lakh divided by 15.5 whole into 100, that will give you 200 lakhs. So the market value of equity is 200 lakhs. Then market value of debt, debt is your 50,000 debenture of 150 each. If you multiply 50,000 into 150, it will come to 75 lakh. Or alternatively, you can find also the 9 lakh is your interest. 9 lakh divided by 12%, it will come to 75 lakh. So total market value is equal to S plus D. Sometimes it is D, sometimes it is B. So 275 lakh is your total value of the firm. Now the total value we got 275 lakh. Overall cost of capital EBIT divided by V, that is 40 lakh divided by 275 lakh. It is coming to 0.14545. If you take it as a percentage multiplied by 100, it will be 14.5. So this is what the total concept of NI approach. We will be coming to more problems. We will go for NOI approach. We will go for other approaches, other problems. So friends, if you like the video, please subscribe, offer your comments, because these are very much valuable here. So meet you in the next class.